Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. I'll wait a second here to go live on all the different platforms. Appreciate everybody tuning in on time. We'll get started here in just a moment. Good topic here for today. Something I don't think we've talked about in a long time. So we'll get into that here in just a moment. All right. Okay, looks like we're live on all the different platforms, so we'll go ahead and get it started. We'll take the chat off the screen, but go ahead and keep dropping comments there in the chat as you tune in. Drop any questions you have in the chat as well. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern is this loan officer training series where we do a deep dive into a loan officer training topic. Tonight's topic is going to be how to read a title commitment. So Jose, with 28 years of experience as both a loan officer and a realtor, has read his fair share of title commitments. So I will let him take it over and get right into it.
Good evening, everybody. Thank you for joining us for tonight's training on title commitment, how to read a title commitment. May seem a little boring, but the last thing you want to do is have your closing snagged up because of a title commitment condition, right? So let's get right into it here because I cover it all in the presentation, how to read a title commitment. So what exactly is title insurance, right? I mean, it sounds something bizarre, right? Insurance on a title. Well, we're not talking about like the title of a movie. We're talking about the title of real property. Title insurance is a form of indemnity insurance that protects lenders and home buyers from financial loss sustained from defects in a title to a property. Lenders will require title insurance, referred to as lender's title insurance, equal to the amount of the loan. Now, home buyers can purchase an optional, even though highly recommended, but it is an optional owner's title policy that will protect them for the difference between the purchase price and the loan amount. What does that mean? That means that you got your lender's policy, your loan amount was $100,000. You bought the property for $200,000, right? So $100,000 is owner's coverage at the beginning and $100,000 lender's coverage. However, as that loan gets paid, right, now you may only have $80,000 in loan balance. So you have $80,000 in lender's coverage. But guess what? Now your owner's coverage is $120,000. So that's how that works. So definitely for the cost of the owner's policy, it is usually, or I would say always, highly recommended. So I briefly touched on it, but what is the importance of title insurance? Well, the lender's policy, right, the one that we got that is equal to the loan amount at the closing of the loan, ensures that the lender is covered for the term of the loan, as long as there's an active loan, for any document issues that may arise that were not noticed during the title review. The owner's policy ensures that the owner is covered for any covered losses for as long as they own the property. Now, why is that important? Well, let me go into the issues that are some examples of issues that are covered. Then I'll relay an actual example. So issues that are covered include, but this is not an exclusive list. This is just some of the items: fraudulent or forged deed, unpaid property taxes, construction lien, any other unpaid liens like a municipal lien, state lien, tax lien, incorrectly completed documents, prior mortgage not paid off, or any unpaid assessments. Now, the unpaid assessments, mortgages, taxes, stuff having to do with liens, all of that is going to be covered in Section B, which I'll get into in a minute, Section B of the title commitment. So why is the owner's policy so important, for example? Well, I had a scenario where we closed on a transaction, right? The property was in foreclosure, but we closed it. We closed it like with 7 or 8 or 9 days to spare. But apparently, the title company did not send in the documents right away to record, as is the habit. Sometimes for title companies, they'll group together the items that they are going to record and then do them all in one shot. I don't know if they were trying to save a little money, but I would call that penny wise and dollar foolish. Because this property was in foreclosure, and not really sure what happened there, but obviously they didn't record the deed on time. And the left hand didn't know what the right hand was doing, apparently, at the lender that had the loan. Apparently, the foreclosure department didn't communicate with the payoff department or vice versa. And they went ahead and processed the foreclosure. And like 2-3 months after we closed, I get a frantic call from my borrower. Says, hey, Jose, there's a man here showed up at the door of my house telling me that he's the new owner of the property. I'm like, what do you mean? Oh, yeah, he's showing me some court papers. So I went ahead, I called the title company, explained to them what happened. They realized what went down, right? So they negotiated with the new buyer and paid him $15,000 to basically go away, right? Because his deed got recorded first, right? So he took the money and they did whatever corrective documentation they had to do. And my buyer was still whole. WHOLE. She was still whole, still owner of the property, didn't have to move, disaster averted. But what would have happened in that situation there had the borrower not had owner's title? Well, the only thing that would have happened was that the title insurance, if they would not have been able to negotiate like they did with that the new supposed buyer, they would have just had to have paid the loan off, and that's it. The current owner would have been left out to dry with nothing because the owner's title insurance wasn't going to protect them. So it was a good deal for a couple $100 that she paid for that owner's title policy. So how is title insurance protected? How is title insurance purchased? And it is usually purchased through an attorney or a title agent, either or. The rates are usually set by the state. Not every state works that way, but most states have what is referred to as promulgated rates. That means there's a set table, and that's the cost of the actual title insurance policy. But unfortunately, that doesn't cover the cost of all the extra fees that are included. That's just the only thing that's promulgated would be the actual cost of the title insurance policy. When you do purchase title insurance, there's a title examination that occurs, looks for defects in the property's chain of title history. Right. There's also, lien search, which is part of the title examination. Right. They do. And then the title company, those of you in the business, you get the reports. They'll also go into the different websites, pull up any current code violations or notice of violations that haven't turned into a code violation yet, but could be a code violation. And then that code violation turns into a lien. So, they try to nip it at the bud and have those items paid at closing so that they don't become code enforcement violations and liens. The title policy includes a Schedule A, which is a cover page, and it includes a Schedule B1, which is the requirements that must be made to issue the policy, like pay the taxes, pay the current mortgage, stuff like that. Schedule B2 includes the exceptions to the policy or the items that the title company or the title insurance will not cover. These are items such as mineral and water rights, easements, the tax assessments on new construction. It's assessed now at $100,000, or just land value, but that's going to get reassessed next year, and it's going to be $700,000, and you're going to have a big difference there. They're not going to be responsible for the difference between the old assessment and the new assessment. You can try to get a rebate from the old seller, but they're going to tell you, sorry, that deal already closed, and can't do anything about it. So let's talk a little bit about vesting. Now, again, I'm empowering you here so that then when we get to the final section here and actually reading, what you're looking at, right? So another thing to consider in these title policies is the actual vesting. So these are the four most common forms of vesting. You have sole ownership. It's going to be one individual where title is held solely in one person's name. Thus, no one else is shown as sharing an ownership interest except for the named title holder. One person, 100% owner. The next category is tenants by the entireties. Now, this category is for spouses who are currently married. The property can be titled in both their names and held as a tenants by the entireties. This is one of, for example, for Florida, this is one of Florida's best forms of asset protection from outside creditors, because the property is not divisible by creditors to satisfy the obligation of only one debtor spouse. So, this is an asset preservation strategy, I would call it, right? Tenants by the entireties. Now, joint tenancy or joint tenants with right of survivorship is also another common title vesting for two people, usually married, that want the title to revert to only one should the other one die. So basically, joint tenancy with right of survivorship means you hold title equally with someone else. So if it's three people, it's 33 and a third each. If it's two people, 50-50 each. And when one of the title holders dies, the entire interest passes to the remaining surviving joint tenants. It doesn't go to the heirs of that individual. It doesn't go to probate. It's simply, if you had three people on title and one of the people dies, the 33 and a third interest of the person that died is equally divided amongst the two remaining owners. So that's why joint tenancy with right of survivorship is also pretty good asset preservation, but is not for people that want to pass their interest in the property automatically to their heirs. That would be using tenancy in common. In tenancy in common, several parties can own the property in whatever percentages they want, and upon their death, their interest in the property goes to their own estate to be divided according to their will or to their heirs through probate. Now, obviously, you don't want it to go to probate because that's an additional expense, additional time. Also, got to go to court. You would want to have a will, some type of document like that, so that your desires would be followed without legally, without having to go to court, spend money, waste time. So now that we covered some of the basics here, let's look at these sections. Like I mentioned, right? So the first section is section A. This is the section of the title commitment with all the information. So this is pretty cool. You got your file number. The commitment date is the date that the title examination was completed, right? You have your proposed insured, that's our borrowers. You have the proposed policy amount, right? That would, depending on what we're talking about here, if this is the lender's policy, that's going to be the loan amount. Actually, that's the owner's policy on the top there, and the next one below is the loan amount, the lender's policy. So owner's policy for 100, lender's policy for 160. You see Great Rate Mortgage Company is successors and or assigns as the proposed insured on the lenders, and the individual names or whoever is the actual borrowers as the proposed insured. Stating number 3 states how the estate is being conveyed. It's fee simple, right? Fee simple, highest level of ownership. Number 4 says who is currently on title, right? John and Jane Doe, husband and wife. And then number 5, the legal description of the parcel being conveyed along with the address, and then who signed the title commitment. If it's not signed, it's not an actual title commitment. So this is section A, which is the first section. Then you have section B, part 1. You heard me talking about the requirements that need to be met in order for the actual title policy to be issued. That's why they call this a title commitment, not a title policy. Once all of these requirements are met, then, and obviously the premium is paid at closing, policy commitment, the commitment gets processed, and what you end up with in the end is the title policy that's issued. That's why you get it like a month later after closing, that and the recorded warranty deed. So you'll note, I don't know if you can see it there, but these requirements include items like number 9, the company may pay the current year Cook County taxes when furnished an original tax bill at, or because I guess they didn't have the exact tax bill there. You're talking about your satisfactory evidence of identification for the notarization. We're talking about good funds. The proposed policy amount must be increased to the full value of the estate or interest being. So, you got a whole lot of conditions that pay the premiums, fees, and charges for the policy to the company. Obviously, real important. Number 2, pay the agreed amount for the estate or interest to be insured. That means you got to close the deal, right? You got to pay the price. So again, these are all the requirements that need to be met in order for the policy to be issued. And then section B, schedule B, section 2 are the exceptions. Like I mentioned in the previous slides, the exceptions are the items that the title insurer is letting you know off the bat, we are not going to cover any issues that may arise from this. And it's really important to read all of this. Why? Because you don't want to get caught off guard and have some bizarre exception there really be a trigger for something that is wrong and shouldn't be there. Now, what do I mean by that? I had a closing recently, actually mid last year. It was for some properties being purchased from a developer, right? But in the section 2 of Schedule B, it was talking about an exception to an easement, to a declaration, to the easements created by the declaration of covenants that were registered and recorded with the county, city, state. I can't exactly remember, but it was basically something in the public record. So we're like, wait a minute, what are they talking about there? And then that's when we reached out to the seller. They provided the actual covenants that we were talking about, and it was referring to some easements that were there. So the only way that we were able to do that transaction was actually to create a party wall agreement between each of the owners of the units that were adjacent to each other. So it was 5 properties. We ended up having to get 3 party wall agreements, and so that we could close. And that took about 3 weeks. And that 3-week delay was the result of some obscure exception in Schedule B, Section 2. So I would highly recommend that you read all of these and make sure that they're not just something out of the ordinary. Because, you know, the mineral rights, oil rights, stuff like that, that's ordinary kind of stuff. But just look out for anything that is a red flag so that you can, address it with enough time so that you don't delay your closing. That's why I'm saying right here in MLO best practices, our last slide here, trying to tie in these loose ends. So, definitely you want to identify and address any issues up front. Make sure you communicate and collaborate with the title professionals, with the title company or attorneys that issued the commitment. Like I just said in the last slide, make sure you read the title commitment once you receive it. Do not just save it and submit it to underwriting, and then all of a sudden have the underwriter hit you a week later with some conditions that you're like, oh my God, how am I going to take care of this? Make sure you educate your borrowers about the importance of title insurance, about lender's title insurance being required, about owner's title being optional, but highly recommended. You can mention the anecdote that I spoke about, how my borrower got saved, didn't have to put a dime out of her pocket, and the title insurance company had to pay $15,000 due to that mistake that they made. And then last bullet point here, not necessarily having to do with reading title commitments, but if you do read the title commitment and you do see when the seller has been on title, if you hadn't already done that research when you were first structuring your loan, you definitely want to see how long the seller has been on title or how long the borrower has been on title if it's a refi, specifically a cash out refi. And why am I saying that? Well, because regarding seasoning on a purchase transaction, MLOs need to review the property ownership transfers on purchases for non-QM and FHA loans, especially, to ensure that property flipping will not affect the loan requiring additional appraisals. Why do I say that? Well, because if it's a non-QM purchase and the seller just purchased a property, rehabbed it, and is reselling it 60 days later, and is reselling it for 35% more than what he paid for it, you're going to have to meet some additional requirements, right? You're probably going to need a second appraisal. You're going to need to document the upgrades that the seller did to the property. And in some cases, some guidelines may not even want to do the loan. I know one in particular that they won't do anything less than 12 months, regardless of how many appraisals you provide. So you don't want to get caught off guard there in that respect, right? And that's what we're talking about. A purchase. We're not even talking about a refi, a non-QM purchase. Specifically, they're really strict on that. FHA also has the 91-day flipping rule, which means that an FHA purchase, you cannot get into contract until the 91st day that the seller has owned the property. If you get into contract on day 89, you're not going to be able to close that deal. You're going to have to cancel it, do a new contract, do a new transaction, do everything. So make sure if it's an FHA purchase, Your borrower is buying that property. Well, look at how long the seller has been on title. If it's less than 90 days, tell them you got to wait. If it's 91 days, you're good. But FHA does have certain requirements regarding flipping, depending how much profit is being made, and possibly requiring a second appraisal. And if it's a cash out refi, now there's a little bit more common knowledge than the purchases, but I'll still restate it. If it's a cash out refi, the appraised value will definitely be affected if the seasoning on title is not met, resulting in using purchase price plus closing costs or purchase price plus closing costs and renovations, depending if it's on the time frame of the seasoning. Now, we do have at the mortgage calculator 0 seasoning options, but the most common is 6 months seasoning, and then the most conservative, which there are a few options out there that still hold to 12-month seasoning option to use. And this is just to be able to use the appraised value and not have to use purchase price plus closing costs or purchase price plus closing costs and renovations. So as I know now, most of you now are probably going to change your method of operating. Now, when you get that title commitment, you're going to open it up. You're going to look at Schedule A, Schedule B, Section 1, Schedule B, Section 2. You're not just going to save it, upload it to the conditions, forget about it, and then all of a sudden be hit with some weird conditions that you should have known had you read the title commitment. Right. So, I guess the greatest takeaway from here, if you don't remember any of the jargon we went over, the legalese, please at least open the commitment and read it and reach out to the issuer of the commitment with any questions.
All right. A whole bunch of comments in here. Let's see. See if this one, does title insurance protect from errors? You mentioned errors, but I don't think that.
Well, it's not meant to protect you from your errors. The title insurance protects you from claims made by prior owners of the property, for example, or prior contractors to the property, improperly processed deeds in the past, forgeries, mistakes, unpaid loans, taxes, stuff like that.
So in fact, it would protect
Yeah.
your heirs.
Yes.
It would actually protect your heirs from losing your asset, right? That's what we're trying to do. We're trying to protect ourselves from losing our assets.
Such a nominal amount. In Florida, title insurance is from 20575 is the factor for the first 100,000, and then 205.
Something happened to your mic there. It kept going lower and lower until it went to 0.
Yeah, I can't hear you.
Oh no!
Are you sitting on your volume button? There you go.
There you go.
Okay.
All right, now we can hear you. Go ahead.
Okay.
You said it was a low amount, and then you trailed off.
Yeah, I was saying that, for example, title insurance in Florida, the promulgated rate is 0.005 for the first $100,000, and then 0.005 for every $100,000 after that. So it's $575 for the first $100,000, and then $500 for every $100,000 or proportionate share thereof. So it's not that expensive for what you get.
Just got to watch out for the junk fees, right? The actual title insurance won't be expensive. It's if you see some expensive quotes, those will be junk fees and other fees, because the title insurance has always got to be the same cost no matter who's doing it in Florida, right?
Absolutely. One of the things to look out for is the simultaneous issue of the owner's title policy. It's supposed to be $25, right? But that's where they pack it on. That's where they get you.
So you see a $250 fee for that. You notice they're trying to bump it up a little bit. Okay. There's a lot of stuff in here. Let's try this one. New construction. Is there a reason why we wouldn't do title insurance on a new construction?
Well, the only reason somebody would want to not do it, right? The logic they would think, right? Well, it's a new ownership, right? But hey, that building had contractors, right, who could put a mechanic's lien on the property for not just the cost of your house. What if the developer didn't pay them for all the work they did, so they just put a $50 million lien on every single property on the whole development because they haven't been paid? So new construction is just as liable to hit you with a lien as existing construction. So there would be no reason not to do it.
Sometimes more too, because they could build the house over a line, over an easement line, and the entire house is now cannot. It's an invalid house, right? They don't own the house anymore.
It could be all sorts of things. You built it on native Indian land and you weren't supposed to do it. Your house is now worthless. They didn't pick up on that, right? That should have been there in the section B, schedule 2, right? The exceptions. They didn't put it there, right? So guess what? They're going to be paying for your house. Paying for your house what you owe, and if you have owner's title insurance, cutting you a check for the difference up to the face value of the owner's title policy.
And remember, just because they built a new house, land had title before, right? There could have been 1,000 owners. Back to the Indians, as Jose mentioned, right? If the original transfer from the Indian land wasn't made properly, right, you could have an issue. But not only that, you have 1,000 transfers in between over the last hundreds of years that may or may not have an issue just for the land. That has nothing to do with the new house they built on the land, which has additional issues, right? You could build it in the wrong spot, could have a contractor you don't pay, could do it wrong, right? All kinds
of things.
I think it's actually more important. A lot of questions in and out here. Take a Ted's question here. Then irrevocable trust. The information for the property is hidden. Is that right?
Well, I don't know. We would have to read the trust agreement and see how it reads. Now, what I would want to state is that you would, if there's a loan involved, obviously you also want to make sure that the irrevocable trust is acceptable by the underwriter of the loan. But without reading the trust, I can't really answer that question.
And I guess to piggyback on that, to get a title commitment, you will have to provide the entire trust agreement to the title underwriter and the title insurer, right? They're not going to insure it if they don't know who they're insuring, right?
Correct. Yeah, they got to see. They don't know what agreement's been made there. They don't want to be party to some illegal maneuver. So they got to read the agreement. They have to make sure it's not going to incur any weird liabilities, right, to the owners of the property.
So it is a vehicle to hide some stuff from some people, but in this case, you have to full disclose it so that they know what they're getting into to issue the title policy.
Right.
Natalie with another one here. Who pays for lender's title? Who pays for buyer's title? This is a good question.
That's a negotiable item, basically. It varies, like South Florida, Southeast Florida, for example, almost 99.9% of the time, the buyer pays for it. Buyer wants to make sure they get their representation. We were just discussing that earlier, Nick. Buyer wants to make sure they get their representation, their best interests are covered, because even though we know the title insurance company, agent, attorney is supposed to do a good job, a solid job, honest job, sometimes you never know what may happen. You're talking about a lot of delicate paperwork. You're talking about liens that may or may not be noticed and brought to light, or maybe noticed but not brought to light. Like I had one where we used one of those home path foreclosures. We used the home path title insurance because they were paying for it. And when the seller, who then became, the buyer who then became a seller after they rehabbed the property, went to sell it, guess what came up that was found out by the buyer's title? A $15,000 lien from the city. Now, did the prior company not notice that, or did they just overlook it? Was it a mistake? Was it done on purpose? Don't really know, but they covered it though. they covered it because they didn't have an exception for it. They had it nowhere listed on their documentation. So we were able to get an indemnification letter from the prior title that said, hey, we're going to pay for it. And with that, we were able to close the loan. So, yeah, I mean, who pays for it is whoever you want to pay for it. The buyer wants to pay for it, they'll pay for it. In some areas, in real estate transactions, you see a lot of times that the seller will designate title and the seller will pay for it. Now, I don't know if you could argue the point, say, I don't want to use your title company, I'll use my own, I'll pay for it. But, a lot of areas throughout the country, they tend to have seller paying for it because the seller's designating it when it's a real estate sale and purchase.
That goes right into the next question. If title insurance is not in your control, can you change the company? So that's a good question, right? If seller is choosing and you don't like the way they're choosing, what can we do?
I guess you'd have to see how the contract reads. You'd have to bring that up. That's going to be a point of negotiation. I mean, if it's part of the negotiation, the buyer can always counter offer. Hey, you know what? I don't want to use your title company. I want to use my own. I'll pay for it. Doesn't matter. At which point, if they say no, you might wonder, is there an ulterior motive? But I understand sometimes the sellers will say, well, I just want to make sure I know what's going on. I want to make sure I get my money at the closing. And the buyer, on the other hand, is saying, I want to make sure the title is examined correctly so that I don't have a $50,000 lien 3 years from now when I go to refinance.
Yeah, I had that, Nick, one time at one of my first rental property that I had purchased. When I went to sell it, found out there was a lien from the city that title missed, and we had a great title agent and great attorney involved, but some things get missed.
For something as trivial as it was a dog bite, right?
Mm-hmm. Yep, and it was gonna stop my sale for a dog thing
at the closing table. Yeah, signing closing papers. You found out about a dog bite for $150. It was going to derail the whole deal, right?
Well, it was $500 and something dollars.
The original ticket was $150. Yeah, exactly. Right. $150 ticket.
Yeah.
Derail the whole transaction.
That's the reason why some property owners don't want pets in their rentals. It's not necessarily because they're afraid the dog is going to smell up the property or anything like that. It has to do with if the tenant doesn't get the dog vaccinated, right? There's going to be a violation issued, and if there's one for rabies vaccination that gets issued, then there's one for like the other stuff that can get for not getting the license. So those are two that could add up quickly to $500. And the worst part about it is that violation does not follow the tenant. The tenant leaves. Even though they got issued a violation, they're scot-free. That violation is tied to the property.
Yeah, I never lived there. Never had a dog, and never
had a dog.
So, yeah. So, all right, cool. Well, I don't see any other questions, I don't think. So let's go ahead and wrap it up. But this is very important, and I think that was a great lesson here today, Jose. So remember, everybody, that we do this at 7 p.m. Eastern time every Tuesday, Wednesday, and Thursday now. So now we are doing Thursdays as well. So thank you, everybody, for tuning in. We'll be back tomorrow with a new topic. We'll see you tomorrow, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.
Thanks, everyone.